From their very first day on the job, every American is indoctrinated with the same sacred mantra. We're told, work for 40 years, faithfully set aside a percentage of every paycheck in a special savings account. And when you retire, you'll be a completely free person sipping cocktails on the Florida coast. This is the central economic illusion upon which the entire concept of the docile American middle class is based. But today, in July 2026, millions of U.S. citizens approaching retirement age are discovering with horror that this idyllic picture is a colossal deception. A comfortable retirement does not await you. You are trapped inside the most sophisticated financial trap devised by Wall Street bankers to devour your savings long before you live to see your first retirement check. Let's turn to the official evidence that the U.S. Internal Revenue Service and commercial funds are trying to hide behind complex legal jargon. A recent macroeconomic report from the U.S. Bureau of Labor Statistics on the Consumer Price Index, CPI, revealed that 5 years of structural inflation have completely eroded the real purchasing power of Americans' traditional savings, reducing their value by 28%. But the real disaster was revealed by internal analytics from investment giants Vanguard and Fidelity. Statistics have confirmed a record. Due to the inability to pay off current debts, skyrocketing auto insurance premiums, and medical bills, 1 in 5 Americans today is forced to withdraw money from their retirement plans early, paying exorbitant penalties to the Internal Revenue Service, IRS. Where is the money you've been saving for decades disappearing to? How did the classic 401k plan turn into a legal tool for confiscating your capital? This is no accident. It's a mathematically engineered scheme. Welcome to America's retirement trap.
Check out more awesome topics on our channel, subscribe and let us know what you'd like us to cover next.
To understand how you're being robbed today, we must go back to 1978 when Amendment 401k was quietly added to the U.S. tax code. Until then, America had operated under a classic, reliable system of traditional pensions known as the defined benefit plan. Corporations and factories were legally required to pay their former employees a fixed percentage of their salary for life. The risks fell on the business. If a company mismanaged the money, those were the company's problems, not the workers. But Wall Street launched a massive lobbying campaign in Congress and turned the tables. They created the 401k plan, shifting all financial responsibility from billion-dollar corporations onto the shoulders of ordinary wage earners. Big business rejoiced. They no longer had to guarantee you a stable retirement. Now you are responsible for investing your own money in the stock market through intermediaries. They sold this to you under the guise of financial freedom and managing your own investments. But an ordinary teacher, auto mechanic, or office manager isn't a professional trader. They don't know how the stock market works. And that's when the main beneficiaries of this scheme stepped onto the scene, mutual funds, which offered to take your money under their professional management. Thus was born a money-sucking machine that siphons liquidity from the paychecks of the American middle class every month, funneling it directly into the hands of bankers. Most Americans firmly believe that if their 401k account shows a green plus sign at the end of the year, it means they're getting richer. But if you open your fund's detailed 50-page investment prospectus and look for a line written in small print, you'll find the term expense ratio or hidden administrative fees. Wall Street charges you for everything: portfolio management, marketing, auditing, and transactions. At first glance, the numbers seem ridiculous, 1 or 2% a year. The average person thinks, what's 1%? That's pocket change. But that's where the magic of compound interest kicks in, and in this case, it works against you. An independent audit by Harvard's Center for Macroeconomic Analysis has proven the devastating math. Over the course of your 30 to 40-year working career, these imperceptible, 1 to 2% in fees, applied to your total capital each year, eat away at up to 30 to 40% of your total net profit. You bear all the risks. You lose money during crises and market crashes, while asset management firms like Vanguard, Fidelity, and BlackRock take their fixed, massive fees every year, regardless of whether the market has risen or fallen. They get rich off your money while you pay for their luxurious offices in Manhattan. The second part of the trap is the government's tight tax grip. A 401k plan is structured so that you contribute money to it before income tax is deducted, pre-tax. Brokers and employers praise you for this. Look, you're lowering your taxes right now. But they deliberately fail to mention that you'll still have to pay taxes, just later, when you retire and try to withdraw your money. And here, the middle class is dealt a crushing blow by the tax code. U.S. law has set a strict cutoff, the age of 59.5. Until you reach that age, your money is locked up within the system. If you face a crisis, you've lost your job, need to pay for urgent medical surgery or cover a car loan, and you decide to withdraw your own hard-earned money from your 401k account early, the government will immediately trigger a punitive mechanism. The Internal Revenue Service, IRS, will immediately impose an automatic 10% penalty on you for an early withdrawal, hardship withdrawal penalty, and it will add the remaining amount to your current annual income, subjecting it to the standard, exorbitant state and federal income taxes. As a result, in an attempt to save yourself from bankruptcy, you instantly hand over 40 to 50% of the withdrawn amount to the government. Your money doesn't belong to you, it's held hostage by the system. But even if you exercise iron discipline, leave the account untouched until age 60, and meekly pay all of Wall Street's hidden fees, the system's final, most cynical surprise awaits you: structural devaluation. 401k plans are calculated in nominal US dollars. When you see the coveted $300,000 or $400,000 in your account, you feel secure. But over the past 5 years, the Federal Reserve has printed so much unbacked liquidity that the real purchasing power of the US dollar is in a prolonged slump. Consider the real inflation rate for the basic needs of the middle class. Food, insurance, rent, and healthcare have risen by 25 to 30%. This means that the $500,000 you've saved by the time you retire will, in terms of real purchasing power, be equivalent at best to $200,000 from the past. For 40 years, you've denied yourself travel, shopping, and a decent quality of life, putting every penny into your retirement fund, only to discover at the end that the system has handed you worthless pieces of paper that can't even buy basic health insurance in your state. The American dream bubble has officially burst.
Check out more awesome topics on our channel, subscribe and let us know what you like us to cover next.
The 401k pension trap is the perfect long-term money pit, designed by Wall Street to keep the American middle class in total dependence on corporate jobs. If your savings are locked up in the system until you're 60, you'll never dare to quit your job, start your own business, or stand up to management's whims. You become the perfect, obedient cog in the debt machine. But how can the average person break this cycle, protect their accumulated capital, and avoid ending up with nothing in their pocket in old age? As your personal financial analyst, I'm giving you 3 proven rules for protecting your retirement savings. Rule 1. Maximize the employer match and set an immediate stop. If your company offers an employer match, where your employer doubles your 401k contributions, for example, you contribute 4% of your salary and they add another 4%, take full advantage of this up to the free matching limit. This is the only free money available in the US market. But under no circumstances should you contribute a single extra cent to your 401k beyond this limit. Anything above that should be placed under your own strict control. Rule 2. Switch to robo-advisors and low-cost ETFs. Stop lining the pockets of mutual fund managers with their extortionate fees. Take your excess capital and invest it yourself through simple brokerage accounts in low-cost index ETFs, such as Vanguard's VOO or SPY, where the expense ratio is a microscopic 0.03% instead of 2%. Over a 30-year period, this will save you more than $150,000 in net profit, which will stay with your family rather than on Wall Street. Rule 3. Use a Roth IRA strategy. If your income allows it, shift your focus to Roth IRA plans. Unlike a traditional 401k, with a Roth IRA, you pay taxes now, but all your earnings grow tax-free over the decades and can be withdrawn after age 59.5 completely tax-free. At a time when U.S. national debt is breaking records and future taxes are guaranteed to rise, locking in your tax rate today is the wisest decision you can make to protect your future. The system remains strong as long as you blindly believe the promotional brochures of commercial banks and are afraid to take responsibility for your own money. But as soon as the middle class applies cold, hard math and becomes aware of the reality, the shackles of debt crumble to dust. ZKT. In our upcoming investigations on this channel, we'll continue to unmask the most cynical conspiracies of modern macroeconomics. We'll break down the shady schemes in the real estate market in detail, reveal the hidden traps of bank cards, and help you maintain control over your capital. If you want to see independent, fact-based analysis, protect your money, and live freely, subscribe to the channel and turn on notifications. Give this video a like if this analysis opened your eyes to reality, and be sure to leave a comment. Do you contribute to a 401k? What fees does your fund charge? And do you believe Wall Street will ensure you have a comfortable retirement? Let's break down your numbers. See you in the next investigation.